Good morning.
Good afternoon. Good
Good
evening.
afternoon. Yeah, we're like basically in the same time zone.
Yeah,
I don't know why I said that,
almost.
but
Almost.
almost. Um, Thank you for coming to talk to me today. I've been trying to kind of just like talk to people that are better at investing than myself whenever I have like investing questions.
I
And
wouldn't call myself better, but I appreciate the compliment.
and the thing we're talking about today is a topic that you definitely have a lot of experience speaking about. Um, yeah, it's one of these things that's like anytime I see someone else talking about it, I'm always like, oh yeah, Anthony, like it's just like you're the poster boy. They should be putting you on the payroll for shareholder relations.
Yes. I've heard that a lot actually. A lot of people are like, why don't you just go work for them? And I'm like, they work a lot of hours. A lot more than I would like right now, but yeah. No,
Yes,
I appreciate that, man. I'm a big
yeah,
fan.
yeah. So we're talking about Brookfield mainly. But I will put it on screen. I This started a few weeks ago. I tweeted, I'm looking to study some companies that acquire and then operate the businesses. Like kind of like Exchange Income Corp, which is a company here in my city, Winnipeg, that I went to their shareholder meeting and they kind of do that with like airlines and some other things. Um, and then I said like more hands on than like Berkshire Hathaway, for instance, because maybe like earlier, when Warren was a 30-year-old man 216 years ago, maybe they were buying like I'm thinking of like their Dairy Queen acquisition where they're buying like
Yeah.
100% of companies and operating them more,
Yep.
putting their people in places and kind of operating. But as far as I'm aware, in the last like maybe decade, it's been more passive, kind of just buying chunks of companies. Um,
Correct.
yeah, I remember when he bought Occidental Petroleum. He
Yep.
bought like came out like bought 30%, and they had to have like an emergency board meeting, and he was like, no, guys, I'm not hostile taking over you. I just like the company. Keep doing what you're doing, and they were like, oof, okay.
Yes.
Um, so I'm looking to study more companies that kind of do that. They'll like purchase companies. So whatever you call that, like an acquisition company.
Yep.
Not
Sale
really
acquirer.
a yeah, yeah. And it's funny because I tweeted that, and all the responses are like telling me who to invest in. But the reason I was asking is because I'm trying. I think kind of where I want to go with my business career is I want to build a company like that.
Hmm.
So for the listeners, just quick, I started a company when I was 18 years old. And then when I was 27, I acquired another company for six figures. And, I have a couple other things on my radar, and I kind of want to acquire companies and put people in place and run them and kind of build a company like this. Um, and then it was just funny how people were like, "Don't do that. Just invest in the S&P 500. Don't invest in weird acquisition companies." I'm like, I want to be the weird acquisition company. And you weren't the only one that responded, Brookfield. A couple other people did as well,
Yep.
but you were all saying that you described it as the final boss of this company in
Yes.
this
Oh,
in
I did
this
say that.
category.
It absolutely is, man. Um, Yeah, no, happy to chat about it. And again, I think it's so relevant to your business too, because a lot of Brookfield, obviously, like people know it from the last few years, right? It's really been taking off in especially the FinTwit space, but it's like over 100 years old, and there are a lot of lessons to be drawn from their early, like the first 100 years, to be honest, right? Like very relevant to what you're trying to do. So yeah,
Yeah,
it'll be a good chat.
yeah, in preparation for this, I read their Wikipedia, and I was
Yep.
like, what do you mean founded in like 1780 or something ridiculous?
Yeah,
Doing
1899. But
okay,
yeah,
yeah, I'm
it's a long
still
time.
like
Yes,
long time ago. May as well
very long
be
time.
Jack Sparrow and
Yeah.
running around. I don't know.
Yep.
But so how much of the identity of that company still, because like Berkshire Hathaway was a
Yep.
textile company, right?
Hmm.
How much of Brookfield's identity still lasts from like 1899 till now?
It's different, but some things are still there. Some of the core businesses and some of the approaches are almost the same, but their approach to risk is different. I guess maybe to kick it off, we can go through their whole kind of timeline. We'll make it like we don't have to spend hours on it, but I think it'll help to understand. So 1899, right, was like I said, is the very beginning. It was actually founded by Canadian people, but it was based in Brazil.
Okay.
And we can go back to Brazil after too, because that's a big part of their DNA is Latin America and them not being afraid of being in other countries. But really, what they did, I think it was called the Sao Paulo Tramway and Electric Company, and basically what they were all about was it's like electric utility almost in Brazil, and they installed a bunch of the street lights. They installed electric streetcars. They actually brought the first streetcars to Brazil, and they actually grew quite a lot. And I think by at their peak, they employed around 40 or 50,000 people. So it kind of became a big thing. And that's how it started. But then, in terms of what maybe the DNA or the part of Brookfield that almost kind of remains to this day was what happened afterwards in 1950s, and it's a business called Etper and the Bronfman brothers. Have you heard of Bronfman brothers? Does that ring a bell?
No.
Okay, so they were at the time at least, a very, very wealthy family in Canada. They were a business family. And basically, these two brothers, they were very much like you. They said, we want to make a business, like a diversified type of business. We want to just acquire a bunch of stuff and just build like a super conglomerate business empire. So that they purchased this tramway company, and they started adding to it. So they bought all kinds of stuff, and they were in like every industry. I'm pretty sure they were in alcohol too. I don't know if it was them who owned like Labatt Brewery or something like
It's
that.
coming
Like
full
again,
circle.
like a long time ago, right?
Yeah, yeah.
But anyway, they started doing all of that, and then this is the key here. They hired this guy called Jack Cockwell. He was a South African accountant, and he pioneered a lot of the methods that Brookfield to this day still uses. And that's where you'll have people say it's a pyramid scheme or whatever. I don't think it is, but people can judge for themselves. But basically, what Jack Cockwell did, he said, we need to find a way of being able to do a whole lot of stuff with not a whole lot of money. So what he did is he took some of the funds that they had, and he'd buy 51% of a company, and then that company would take its own money and buy 51% of another company. And they would do this over and over again. And that's how you had one small business that all of a sudden owned like 300 businesses and controlled them. So it's not just about owning, but it's also about having the board power and being able to tell them what to do, right? So in the 60s, 70s, 80s, they grew really fast. Like they acquired, and again, I don't know the exact number, but it was a lot of businesses. And it was,
Just quick, I want to
oh, yep.
just put a note. It was Seagram's distillery that these
Oh,
brothers owned.
okay.
That's
Yeah.
relevant for me because I'm in the liquor industry, but I was
Yes.
I was very curious. And then the Seagram's in like 2000, I think, got defunct, and then they just sold off all their assets. A big part to Diageo, who owns Crown
Wow.
Royal, whose main distillery is in my home province
Wow.
of Manitoba. So, and
Well,
they're
there you go.
the largest, and then apparently Coca-Cola Company bought a ton of their assets as well, according
There
to
you
this.
go.
And
That's what Coke does.
and Universal Music Group and Comcast. I don't know what that's about,
Oh,
but
wow.
that's not what we're talking about today. But
Yeah.
I was very curious if they were in the liquor industry at some point. The DNA was there through through.
It's there, man. So I mean, they got involved in a whole bunch of stuff. Again, they were in like forestry, real estate, mining, like all kinds of stuff. But then, and this is the key and the lesson also for you and for your business, was kind of the fall from grace at the beginning. So they faced a crisis, right? When you have a recession and things are bad, all of a sudden people are scared. Interest rates go up, people want their money back, and stuff gets difficult. So at that point, they had grown very large, but they also had a lot of leverage. The stock fell a lot. I did speak, it was actually 15% of the TSX, apparently. 15%. So that's quite a lot. It fell like 90%. And then what happened is they had to sell off a bunch of them, like pieces of themselves, to just pay back the debt that they had accumulated, right? Things got really bad. And at that point, the Bronfman brothers, they said, you know what, this is too hard. This is actually not fun. We don't want to do this anymore. And they sold their stake and they left. And they left this guy, Jack Cockwell, the South African accountant, by himself to deal with the ramifications and to rebuild. So Jack Cockwell, again, instead of doing like them and saying, I'm going to sell everything off, he said, you know what, we had to sell pieces of ourselves. This sucks, but we're going to rebuild. And then at the time, he actually found this other accountant, and I think he was like in his mid 20s or something. He was this very, very clever accountant from Manitoba, actually, from Winnipeg. You may have heard of him. His name is Bruce Flatt. He found him, hired him, and they started rebuilding. And so a lot of it was cleanup. So just again, get rid of the bad assets, the ones that aren't cash flowing properly or that have cash flows that are very volatile. At the same time, Bruce Flatt, again, he spent those 10 years from the 90s, 1990 to 2000, just learning, and doing a bunch of like, the grunt work. And then in 2000, he became CEO of Brookfield Properties. At the time, they still had their other name, Brascan. And 2002, he became CEO of the new full Brookfield. And that is where the full reorganization of their business model happened. So, like I said, they got rid of the assets that just were too hard to operate. And again, they had 100 years of experience at that point of operating businesses. So they kind of knew at that point, all right, what are we going to do? And they decided to reorganize into a much simpler structure that focused on real estate, financial type ish of services, and like hydro, utilities, renewables, infrastructure. So that's kind of what happened. And they were very successful at it. And then this is the super genius part. And again, this cements the final new iteration of Brookfield is they said, we have 100 years of experience operating assets. We made mistakes, but now we're pretty good. We've learned our lesson. We should get paid for that by other people. So they said, how about we use the same skills that we use anyway, where we make our own money, but we take other people's money and we can make bigger deals. We can get the scale because the deals are bigger, they'll make more money, but they can also get paid as like a manager, right? A management fee. So they started knocking at doors of big institutions. So we're talking like pension funds, sovereign wealth funds, and they were getting rejected. Like it wasn't working at the very beginning. But eventually, they started getting these little contracts, and it was small, like, 5 million, 10 million, 20 million, small numbers, peanuts. But their funds were really, really good. We're talking, and by the way, this is on the website. You can find it somewhere, but they put like the internal rate of return, right, of the funds. We're talking high teens, right? So if you compound high teen returns every year, you end up doing really well. So then, as the snowball of their asset funds started growing, so did the clients. People, instead of rejecting them, the institutions started coming to them and saying, "Oh, you know what? We want exposure to what we call alternative assets, right?" And then all of a sudden, it really took off, and their growth since then has been exponential. Now, just to give you a bit of an idea, when I first invested in them, so over 5 years ago now, their assets under management were roughly 400 billion. As of the last quarter, they hit 995 billion. So they're getting to a trillion basically in assets under management. So that's kind of the trajectory of Brookfield, like a short timeline in history. But in terms of, like I said, the mistakes that they made, the biggest lesson was again the leverage. So having leverage in itself isn't a bad thing, but it's about structuring it in a way that you are safe, even if you get some kind of economic crisis, right? So that means having maturities that are laddered properly. And it also means something else that they're now doing, it's asset level debt, where instead of having, debt where the creditors can just come to you and just take whatever they want, the debt is tied to one specific asset that they have. So, for example, last year, a lot of people were concerned about Brookfield's real estate exposure. Some of their assets didn't do well, right? But the debt was tied just to the one building, for example. So if the bank wants to come back and ask for their money back, the most they can take is that one building, but they can't go after the rest of the Brookfield empire. So that's where those whole accusations of pyramid schemes and people saying, oh, it's a scam and stuff, it gets it a little wrong, is that they have a very complicated structure, but they're actually made in a way that is pretty secure with a lot of levels removed where the top of the pyramid, the Brookfield Corporation, it's going to be really hard to get to a point where that's in trouble because there's everything else first that protects it, if that
Yeah,
makes sense.
yeah, because like as a small business owner, I have what's called general security agreements on everything,
Yep.
where if my business defaults on a loan, they can just take anything I own, any of my other businesses, and that's what they make
There you go.
low net worth and high risk individuals like myself. They make me sign every time I take out a loan. I got to take out a general security agreement. The only
There
time
you
I
go.
didn't have to do that was buying a very large piece of equipment, like a $200,000 piece of equipment for the winery. That then they put the agreement just on that piece of equipment, like you're explaining. But that's something that like held its value. And actually, during COVID, the resale value went up because of just
Oh, wow. Yep.
supply demand, and it was
Right.
impossible to get parts made and overseas and whatnot. So
Right.
um, so they were like, yeah, we can just kind of tie this to that piece of equipment or whatever. But yeah, I have general security agreements, which basically sets up a domino effect if it would ever, God forbid,
Yeah.
if we ever got to a situation. But yeah, like when I did my first acquisition, which has just been over just over a year now. It was June 2023, and now it's August 2024. um, Basically, I put all of the purchase price on the new corporation. So we took
Okay.
a 5 year, 6 year loan, amortized the loan or whatever. And I put like
Yep.
I think I put 15% down. Me and my business partner split the cash just from our, personal savings. We vendor took back, a vendor taked back, vendor. We did a vendor take back agreement.
Okay. Yeah.
Uh, with for another 15% with the old owners, which basically means they're mortgaging the business to you, or you're paying them. Our deal was we would pay them an extra 15, or the 15% of the purchase price we deferred for a year, basically. So they basically
Okay.
loaned us that money, interest free, which is pretty common in these kind of deals. Um, and then we loaned the remaining, whatever my math is, 70% of the agreement. But the I didn't loan it. The new numbered company corporation that purchased the assets of the business in the
Uh-huh.
acquisition got the
Yes.
debt all put on it.
Yes.
And then we just added those monthly payments, whatever it is, $1,500 a month, to the cash to the expenses of that new business,
Yes.
which is good. Um, but I mean, like rates were already pretty high when we did that, so I wasn't too worried. I got a lot of loans for my other business at like prime plus 7 when interest rates were 0%. Um, and now I'm not laughing at 14% interest or whatever I'm paying on some of these
Oh
loans, you know
wow.
what I mean?
Yeah.
Because they're all
Damn.
floating.
Yeah.
Yeah. Or even taking $300,000 at, 4%, and now it's at 10% just because rate
Oh,
went up. Yeah.
yeah. That makes a
Yeah.
difference. That's actually,
Yeah.
oh, whoa.
Yeah.
Yeah.
So that's not great. But yeah, so I empathize when you're talking about oh, we bought all these, everyone's a genius in a bull run, right? Like anyone
Yes,
can buy a
of
business and
course.
make some money when people have discretionary spending.
Oh, yeah.
But then there's a crunch and a, global pandemic, global recession, name a thing. And it's interesting. Um yeah, because I guess like I'm looking for relatively recession-proof businesses. I mean, like the winery, sure, people, spend less on going out and drinking alcohol when when times are tough, but also like people don't stop drinking when
Oh,
times are
yeah.
tough, right?
No,
Like
people will always drink. Yeah.
yeah, during Prohibition, actually per capita in America, drinking went up when
Huh.
they weren't allowed to do it, which is I find pretty funny. Um, but yeah, people drink when they're sad because they're sad. They drink when they're happy because they're happy. They drink when they're rich because they're rich. They drink when they're poor because they're poor.
Yes.
So I don't want to call it recession proof because I'm definitely hurting, but it is, recession resistant, let's say. And then my other business, we manufacture rubber stamps mainly. And like most of my clients are government funded or lawyers, like big
Right.
banks, big law firms, credit unions, and then schools, which are all government funded here.
Mhm.
And none of these people are nickel and diming me. Like they don't even ask the price. They're like, we just need this. Like, so relatively, I would say recession proof. They took a little bit of a beating, which was actually why, and I'm sure this is a big part of these kind of companies is being able to identify opportunities. Like, who said it? Like identify when an asset is underperforming and then buy it, right? And then just wait
Yes,
for it
and
to
then fix it
perform.
up.
Yeah.
That's a
So
big part of the Brookfield formula.
So
Um,
I'm good to hear that because that's
yeah, yeah,
basically what we
yeah.
did too. Was we looked at these books for the stamp company, and they were artificially low because work from home was so popular
Hmm.
that these law firms, these schools weren't in person, so they weren't using the stamps or whatever. So we actually bought it for like $100,000 less than they had it listed for
Oh,
two
wow.
years before. But
Yeah.
they were just trying to retire. They had their nest egg. They told me they're like, we would have closed it, but we've been working here our entire lives, like 45 years they worked there. It's they care
Hmm.
about it, and they didn't want to just see it go. but it wasn't about the money for them. Like after capital gains and whatever, I don't think they made any money on the sale.
Wow.
But they had it listed originally for like 275, I think, and I bought it for 110.
Oh, wow.
But it was just COVID reduced their sales and it was kind of on a spiral. And then they were kind of had a foot out the door because they wanted to retire. And so
Yep.
we looked at all these situations and it was like, okay, if anyone was going to put this business out of business, it was either going to be the internet or the pandemic, and neither did. So I think this is an underpriced asset. And then, yeah, lo and behold, the first year we took it over was our best year in 6 years.
Wow.
And then,
Congrats.
thank you. Yeah. And then I don't know if you saw my tweet the other day. We invested relatively heavily, like tens of thousands of dollars in equipment recently.
Yes.
But I've gotten like some of the stuff, we were outsourcing about 50% of the products that we made when I got there. And now we're outsourcing less than 10%. And some of the like I was going over some of the numbers. Like something I used to pay $45 for, I now cost me six. Something I used to pay $20 for
Wow.
now cost me two. Like just bringing it all in house and automating and modernizing a little bit. So we were able to identify a business that was underperforming, get it at a good price, and then increase my overall sales, my margins, and just overall operational efficiency. Um, and if I can do it at $100,000, why can't I do it at that $1 trillion?
That's
Like,
exactly it. So what you're saying reminds me exactly. And again, this is what you're describing is exactly the Brookfield formula, right? I mean, it's very common in like private equity businesses at the core. That's what they try to do. But have you heard of Westinghouse? You heard of that?
yeah.
Westinghouse is one of the world's preeminent manufacturers of nuclear reactors and service. So they sell services to other nuclear reactor companies, basically.
Mhm.
And obviously, it's a huge part of like the energy transition because all of us care. We want to have less emissions. Nuclear energy obviously has is amazing. It's green energy. It's not renewable energy, but it's not. It's emissionless, right?
Yeah.
So Brookfield bought Westinghouse when they were struggling so bad. Like they were barely making any money. They were all over the place. It was a disaster. They bought them when they were like almost about to go bankrupt. They did exactly what you said. They just did a big cash infusion. They rescued it. They got it back on track. And then they sold it. I like a massive profit. And but what's funny is they sold it. And this is also, by the way, something that some of the Brookfield detractors don't like very much. And I get it. They sold it to another part of themselves. So Brookfield originally, it was one of the Brookfield children. It was Brookfield Business Partners is the one who bought it. And then they sold 51% to Brookfield Renewable and 49% to another company called Cameco or Cameco. I don't know how to say it, which is also a nuclear-ish type of company. But at its core, it's exactly what you just said is buy a business that's struggling, fix it up, but put some cash in if need be, and then, sell, rinse and repeat. And that's
Yeah.
what they're doing with all their assets.
Yeah, I think I prefer the model of like hold on to the businesses
Mm.
relatively indefinitely and then
Oh
just kind
yeah,
of like keep stacking dividends
they
basically.
do that too for
Yeah.
their core, what they call like like their favorite assets, right? Like was thinking like a Canary Wharf, which is this amazing real estate like area in London, right? Which I visited last year. It was so fun. That, for example, is a hold forever. Or like the Brookfield Place in Toronto, in New York, and all these other places, right? Like Manhattan West, all of that they're keeping. It's the core portfolio. But then they have other assets, right, which is very opportunistic, where they'll buy when it's undervalued and then try to
And
sell.
then, yeah, I bet there was a lot of those opportunities in the pandemic and
So
whatnot
many.
there where you could, yeah,
Yes,
yeah, easy make a couple $1 billion in 5 years. Can't
literally.
be mad at that.
Yeah, man.
So you kind of touched on it, but I wanted to ask because it not that it confuses me, but I guess I want to know your opinion on why so many subsidiaries because I
Yeah.
don't think that's super
Yep.
common from companies at least that I've seen where they like chop up and like we always talk about like simplicity for investors is important
Yes.
because when there's too much digging. There's too much to think about. People go, okay, I just won't invest in that company.
100%.
Especially for public companies, right?
Yes.
So when we're like talking about Brookfield and I search the ticker on my phone and I see Brookfield Business Partners, Brookfield Infrastructure, Brookfield
Yes.
Property Partners, Brookfield Renewable, Brookfield Residential. What are we talking about? Why do we have all these?
So the key answer to me is optionality. Remember, Brookfield, Jack Cockwell is an accountant, Bruce Flatt's an accountant. When you're an accountant, you're thinking about your numbers, you're thinking about making the company in a structure that gives you the most opportunity with the lowest amount of risk. So I'll give you an example, right? Let's say you have a Brookfield and it contains everything. A lot of investors will say, I don't want to invest in it, it's too complicated, I don't get it. Or some investors will say, oh, I love Brookfield renewable, like their renewable assets, but I hate their real estate, right? Now, if you have subsidiaries in everything that you do, then all of a sudden you have optionality because you have some investors will say, well, actually, I love the renewable and I'll buy that, but they won't buy the real estate or the infrastructure or whatever, and vice versa. And another thing too is Brookfield itself, they can choose to privatize some at some point if they feel like it. So that's actually what they did with their real estate one, where during the pandemic, their stock did so bad, just that one. And Brookfield said, well, you know what? We feel that it's actually severely undervalued, more so than the others. So they just bought back the entire thing, took it private again, right? Because there was an opportunity. So it's all about, like I said, the opportunities and the optionality. Now, another split that they did very recently, and that one is slightly different, but it's really important to keep in mind here too, was the split between the corporation and the asset manager. So up
Right.
until it was like what, end of 2022, I think, or end of 2023, sorry, you had BAM.A, and that was Brookfield Asset Management, but it was actually kind of the entire thing. So it was what Brookfield Corp is and what Brookfield Asset Manager is. And then what they said is, let's let's make Brookfield Corp kind of like almost like a mini sovereign wealth fund where this is the top of the pyramid, and their only focus is on collecting cash flows from all their subsidiaries and then reallocating it opportunistically where it makes most sense. So some of that reallocation could be they buy back their own stock, which they're doing anyway. Another of it could be they make a big acquisition. Another thing could be they put their own money into their own fund that the asset manager manages, right? It could be any of those things. And also, the top of the corporation, that is the one that keeps all of the debt. And then the asset manager has a clean balance sheet, they have zero debt, and it's an asset light business. So they don't own the assets themselves, they just focus on managing the assets and collecting a fee. And that puts them on the same level as the other big private equity businesses, the biggest one being Blackstone. That's their evil twin, right? You probably heard of Blackstone. That because that's the same business model, and of course, some of these asset light businesses trade at a higher valuation as well. Because at the end of the day, this is part of what's been frustrating a lot of Brookfield people for a long time. Is because they were so complicated, they consider themselves to be undervalued compared to what they think they should be worth, right? And we call that, there's a name for it, right? It's the conglomerate discount. Is if you're so complicated, the market is going to undervalue you because
Yeah,
it doesn't
no,
like it.
no one wants to read your 10K if it's
Exactly.
50,000 pages.
Yeah. So
Yeah.
that's why they made all these separations, and they'll continue doing it if they keep adding more verticals. If they do, like, I don't know, Brookfield Technology Partners or something,
Mhm.
they'll spin it off as well for sure.
That's an yeah, that okay, that's a bunch of points that I didn't really think about. Where if yeah, I was almost thinking the opposite. Like I wasn't thinking like, oh, I don't want to invest in something. I was thinking the opposite, where it's like, oh, I want to invest in part of this company. But it's interesting that it's like, oh, I don't want to invest in your REIT, but I want to invest in your nuclear power facilities. But I have to buy this. They're one stock. I have to buy them both. But if you split
Yeah,
them
man.
up, then they're not. That's an interesting way to go about it.
100%. Another
Um,
thing too, just quickly to add,
yeah,
is
yeah.
that they can use their subsidiaries, like their ownership in subsidiaries, as currency. So they actually did that last quarter. That was so cool. And again, these guys are accountants; they know what they're doing, right?
Yeah.
But they sold 2% of their Brookfield asset management position so that they could buy this very large insurance financial services company to add to their Brookfield reinsurance position, right? So in the process, by the way, they did that so that they wouldn't have to dilute shareholders, right? Because the other way that they could do it would be to issue more
Issue more
shares,
shares. Yeah.
which no one wants. or to take on debt, which they also don't want to do, right? So they can just use it as a currency. And again, it's all opportunistic. Imagine that Brookfield Asset Management, for some reason, it trades super high. They could sell some of that and then buy more of their own Brookfield Corp stock, right? That's
Yeah.
what Bruce Flatt did personally when the split happened, because right after the split, the asset manager actually did quite well on the market, but the corporation wasn't doing so well. So Bruce Flatt sold some of the BAM and bought more of the BN, right?
Yeah. So is the because all these subsidiaries are publicly traded.
Yes.
How much of what's the percentage of ownership from BAM
Yeah,
on all
I,
these
I
subsidiaries?
don't have the number in front of me, but
Sure,
Brookfield Asset
approximately.
Management, it's like 72.
Okay.
I think the renewable is like maybe 40. The business partners, I think, is the most, like 60 or 50. The infrastructure is probably like 30 or 40. It's ballpark around these types of numbers.
Yeah.
It could be a little wrong, but it's something like
Yeah.
that. Yeah.
I guess like my question for that is like, does it ever is it ever a possibility that somebody could, corporate raid one of the subsidiaries if they only
Great
own like
question.
30% of
Okay,
them?
amazing question. Let's talk about that. So that's another one of their well, it's not even lesson, but it's something that they started from the Bronfman times with Jack Cockwell is power. So these guys care a lot about control and power, right? That's when they started doing this 51% ownership in everything. It's not just about the number, but it's also they've legally tied up the structure so that even if they own less than 50% of one of the subsidiaries, for example, they still control them, right? So
Okay.
at the board level, they have like super voting shares or whatever where they
Okay.
still control the majority of stuff, and they have that for everything. So actually there's this really good podcast that talks about Brookfield that's a bit outdated now because it's from before the split, but they literally said Brookfield is a benevolent dictatorship because the partners, those are the people that have been there for a long time, they still control everything. By the way, Jack Cockwell, who's, I mean, he's been at Brookfield since like the 60s, right? He's still on the board, he still exists, he's still alive, he's still there, right? They also have this other company. It's called Partners Value Investments, and it actually trades on the stock market. You can look for it. It's pvf.un. And basically, that this company, it's basically people like Bruce Flatt and Jack Cockwell and others that just owns a large chunk of Brookfield. I think combined it's like 8 to 10%, something like that. And then by themselves, the people own the remaining, like, let's say 10 or more percent. So the Brookfield senior leadership, uh, together, they own approximately 20% of it. But in terms of voting power, they own the majority.
Okay.
And that's going to stay like that forever.
Because that's how they're structured, is they kind
Yes,
of want
that's
to,
how
yeah.
they've built themselves. And then in terms of promoting people, they really hate outsider. Like they don't want to hire people from outside. They want to keep promoting people who've been really good within their ranks for a long time, right? So they just selected their next guy who's going to be the next big president, CEO, and all of that. His name's Connor Teskey. He's actually the same age that Bruce Flatt, sorry, was when he took control of Brookfield, right? And they did that. They took a young guy, but who's been there for like 10 years, because again, it's all about preparing him and long-term kind of thinking. So now they fully expect Connor Teskey to, be with Brookfield for the next 25 years, the way Bruce Flatt has been at the helm for the last 25 years, right?
Because I mean, yeah, Bruce Flatt is 59 years old, and as far
Yep.
as like high-powered CEOs go, that's not very old.
Mm-mm.
Like,
I mean, he's
um,
he's still going to be around too, and
yeah,
eventually, when he stops being CEO, he'll be executive chairman. He'll still be there.
yeah, yeah. Because like that's like when you think about all these like famous, investors, they're all ancient,
Yes.
101 years old.
Yes.
Rothschilds and Warren Buffett's and whatnot are all, because it takes you a while to accumulate a lot of money,
Yes.
and 59 years old, I would say is doing very well for himself, and also like I would say that owning 20% of the company individually or through his with his partners
Yep.
is
As a group.
probably high as far as
It's
like public
gigantic.
companies go,
Oh,
right?
it's a
Like,
lot. Yeah, yeah, yeah. I
yeah,
mean, he personally owns like $4 billion worth of Brookfield. That's huge. Like most
yeah,
CEOs in general, they don't own that much, right?
yeah.
So
Every
yeah.
public company that I have friends that have family in that are like executives in public companies, and they have good like stock matching programs and stuff like that. They're not getting enough to have a board seat.
Yep.
They're not getting 1% of a company. Like they're getting a fraction of a fraction of a fraction of a percent.
Yes.
Nothing close to 20% of a company with billions in assets under management, right?
Yeah. No, this
So
is definitely next level. Yeah, it's very rare, this kind of structure. And again, that's why a lot of people compare them to like a Berkshire Hathaway
yeah.
or something like that, right? It's like a Berkshire Hathaway of Canada.
Well, yeah, I'm have his Wikipedia open, Bruce Flatt's that is, and it says he's been referred to as Canada's Warren Buffett
Yeah,
due
there you
to his
go.
value investment style, and Forbes gave him like CEO of the year in Canada.
Not
With
surprised.
yeah, that's yeah, and in the
Another thing too, though, that I
yeah
really like and that I think differentiates them from some of the other private equity people now is that even though, with all the accomplishments that they have, they're actually not very flashy, right? It's not like an Elon Musk type of personality where it's like tweeting all kinds of nonsense all the time. And it's nothing like that. It's really staying very strictly on message. And even though Bruce Flatt is the face of it, they're actually very much a team and they're very humble. And that's also why, for example, he outlined himself like they focus a lot on hiring all those people, like promoting from within and highlighting the team. They have it like a bunch of lieutenants, right? It's not just Konoteski, but it's a bunch of them, and it's about the team. And he himself says, "I will have done my job when everyone forgets about me, and it's all about the younger generation." That's very important in a leader and in the long-term mindset. So that's also part of why I love them so much is that their interests are very aligned with shareholder interests. You know
I
what I
could
mean?
yeah, I do. And I definitely could see that somebody owning 20% of the company like this, that if you don't like them, that's where you could not like the company as an investment, right? The
Yes,
same way if you don't like Elon Musk personally, you're not probably not going to invest in Tesla. And I don't think
yes,
anyone's like making that distinction with like, well, I hate Elon, but I'm going to invest in Tesla. It's like,
that's very
he's
true.
kind of the face of it, so that's you're kind of buying the person. So I could definitely see investors that if they don't like this guy, they're not going to be buying. Whereas there's some big companies that it's like don't really have that. They don't have this kind
Yes,
of face personality CEO, and then it's like kind of, so it's kind of a good and a bad thing, I guess.
yes. But
um
but but the point that I'm trying to make though is that it's basically not about him. It's about
yeah,
continuity. You know what I
yeah,
mean? It's really a
yes,
group.
yeah. So as far as their like acquisitions, like nowadays, how many companies would they buy in a given year or in a given
So
5 years?
I mean, every couple of months you'll see news about them acquiring something. I think what's changed a lot recently, right, is the size of the acquisitions. So when they started again, because they were only doing that with their own money, it was very small potatoes, right? But
Yeah,
now it's like, $5 billion here, $8 billion there, right? One of their bigger ones that they did in recent times was Triton International. This one, by the way, was such a good company. I want to say it was $6 billion, maybe something like that, maybe a bit more actually. But this is the largest in the world company that leases these like shipping containers that you put like cars or all kind of whatever things, and then the ships transport them around, right? This
yeah.
was an S&P beating business for 20 years, right? Like beat the S&P 500 with amazing dividend growth and earnings growth and free cash flow and all that kind of stuff, right? And Brookfield Infrastructure took that private. And so, like I said again, I was like, I think it was $6 billion or something like that. It might be a little off, but anyway, that's the kind of ballpark for the size of the deals that they're doing now. So they're looking at bigger fish, and they're able to do that because they get bigger money from more and more institutional investors.
And how often are they buying like 100% of a company?
It's a mixed bag, but most of the time they do, or then I mean sometimes it's like a consortium, right? Where they'll try to do it with others. They tried to do that with something called Origin Energy, but it didn't pan out because it wasn't accepted by the Australian regulators. But usually they will buy 100% of something. And again, they do it because they get the money to do that.
Yeah, because I guess like, yeah, like if you're not buying 100% of a company, it's hard to really take it under your
Control.
kind of ethos
Yes,
and update it the way you think.
exactly.
Yeah.
Yes, that's the whole point for them is again the control so that they can run it the way that they think it should be run and they just decide how best to dispose of it afterwards if that's how they choose to move forward, right?
Yeah, and like you were saying, must be a regulatory nightmare for some of these acquisitions.
Yes, it's
Like
that's the
op,
biggest challenge I think to Brookfield right now. Like a lot of people say, "Oh, it's the debt, it's the real estate." I don't agree with any of that. I think it's the regulatory, it's the fact that even though they have been very low key as a business, just from, by virtue of their size, now they get a lot of negative attention. And also another thing too, by the way, to me, Brookfield is like, you know what a Rorschach test is? I don't know if I'm saying it right.
Yeah, the like splot,
Yes,
like yeah, yeah,
it's exactly that. So people project all kinds of stuff onto it, right? So a lot of people, like regulators, sometimes they'll say it's like, an evil octopus that has tentacles everywhere, right? If that's how you perceive it, then you're going to see problems in everything they do, and you will try whatever you can to block everything, right? So anyway, that's, I think, the biggest challenge, especially as they do enjoy also investing in countries, right, that have much stronger regulatory protections than the US does, right? Like a lot of people sometimes think that, oh yeah, like America is socialist, it has too many protections, but like, man, take a step out of your country and see what the rest of the world looks like, right? Try
yeah,
investing where I'm from in France. It's very different. Well, actually, in all of Europe, right? It's very different
yeah,
ball game. And then they also invest in China, right? And in India. They're all over
yeah.
the place. So anyway, long way of saying that I think regulation is going to be hard. I don't think it'll stop them from doing what like their business, but it will be a bigger challenge.
Yeah, because even in like where they started in Brazil and like South America, like those countries have had
Yes.
history of, electing a socialist leader who then just nationalizes,
Yes.
energy, especially energy, oil production, whatever. So if they, if they're starting as a Brazilian um power company, very easily that could go, oh, sorry, scoop, and
Yes.
you just don't own it anymore. Um so I could definitely see, because like we've talked about this before, where it's like, so I respect companies like A&W Canada or like In and Out that just like focus on their little region and they do it well, and they, they're not overextending themselves,
Yes.
because we always see companies like Target or whatever that like try to expand into Canada and fail miserably. And I can definitely see how it'd be difficult. Like, why? What do you think Brookfield's competitive advantages with being able to like invest in China and India on top of like England and America and Canada? Like, how do they
Yeah.
understand all these different regions and markets?
Excellent question. So one thing that they do again, and again, this is what I mean about the long-term thinking, which I like so much about them, is that they, again, long term, they focus not on making money like this month or this week or even this year. It can be this decade. So that means when they explore a new country, they set up an office there and they can be there for years before they make any deal. That's what they did in India. So I can't tell you exactly how many years it's been, but I know they were there for several years before they did anything. And they were just there, they had their people there, and it was just studying the market, getting to know everyone, and just again trying to understand also how the politicians work, right? The regulatory landscape, all that kind of stuff. Do it for years, and once you know what to do, you make your first deal, but you don't do it by yourself. You do it with prominent players in that country. So in India, they partner a lot still with Reliance Industries. Reliance is kind of like the Brookfield of India, to be honest. It's owned by one of the richest, people over there. And they try to do that everywhere they can. So when you explore a new place, get to understand the land and then work with the people who have already been successful there. That's a great recipe, right? Because then it's almost like they're carrying you, and what you do is really just bring the money and some operational expertise. But they are the ones who tell you about the customs, and this is that person you should be worried about, or all that kind of stuff.
Yeah,
They're
because
doing the
I've
same in the Middle East right now. Like Dubai, man, they're growing there real fast. But again, they were there for a while before they started doing the large deals that they're doing right now. You can expect more of that, I'm sure. Saudi Arabia, Qatar, all those other places. In the next year or two, I wouldn't be surprised if we start seeing big things over there.
And I guess that's like, as long as you can do it,
Yeah,
then having more diversity is always a good thing. But I always am worried of just companies overextending themselves and going into places, regions where they don't know anything about anything, and then they, we're going to make all these changes to this business that's been successful, and then it's like, oh, these changes are really offensive in this culture and country, but you wouldn't have known
right.
that, right?
Yeah, yeah, yeah. Oh, no,
Yeah.
no. So, okay, another thing to be clear too is that it's not just because, yeah, I mean, this is a lot of American companies, especially, right? They'll
Yeah.
just send all their people to a country. They don't speak the language. They don't understand anything. They have no clue what they're doing, and they think that what works in America works everywhere else.
Yeah.
So, to be clear, this is not how they operate. Obviously, they'll send one or two Brookfield people there, but really, again, it's about hiring the best people in every country, right? I mean, if you go to Brookfield's office in Mumbai, it's not, a bunch of Canadian dudes that are there, right? It's the best private equity people from Mumbai who work there. Same with the Dubai office, same with the London office, and all of those other places, right? So they focus on really understanding the place, and that starts with hiring the best people from that country. And they get to hire the best people because they have a lot of money, right? So they're able to do that. Another thing too that I'd say, because you raised a very good point about, the risks of like, oh, why extend yourself somewhere else when you could just focus on being great at home? It's a balance to have. In my view, though, the amount of wealth and opportunities in the emerging world, it's just getting started. There is so much to be done over there and so much opportunity to be captured. And sometimes because it's perceived to be so hard over there, a lot of investors try not to go. And that's the thing. This is part of, again, Brookfield's DNA. They always say that you listen to any Bruce Flatt video, he say, go where the crowd does not go. Most Canadian American businesses are scared of going to India because India is a hard country to work in, right? If no one goes to India, you can go there and make outsized returns. That's the same reason they went to Brazil, right? And they have big pipelines over there. They're doing all kinds of stuff that's been pumping out cash flows for a long time. There is a regulatory risk, but you have to balance that with the opportunity of no one else going there, right? If you can buy a business in India for like, a 50% discount, and there's a bit of a risk of something bad happening versus buying a business in America for like no discount, what's the best, right? It's hard to balance, but anyway, they're kind of trying to do all of that at once. And another thing too, by the way, you have to remember, again, being a private equity business and having these funds, is that they are setting up funds for institutions that want to invest in those countries. So I'll tell you this one thing. They announced, I think it was early this year. Was it last year? No, it was early this year. They announced, they call it the Transition Catalytic Fund, something, whatever. This is basically a transition fund, so renewable-ish type of stuff, but exclusively for the emerging world. And the people that are investing in that, it's like the, Qatar Sovereign Wealth Fund, the Dubai, Emirate, like all those types of people, the Chinese whatever fund. Those are the countries that invest in the fund, right? So they invest in it, and then Brookfield just takes their money and then does stuff in those countries, and then everyone gets paid.
Do
Make sense?
you, yeah, definitely. Do you have any like worries about them moving into like industries that they don't have any experience in? I guess like you just hire or partner with people that have experience. Like, so this is like, I'll compare it to my
I
own
do have
life.
worries. Yep.
Yeah. So this is something that right when I first decided that I was going to acquire my stamp company, first thing I do is get on a Zoom with my lawyer and, go over the particulars and tell them what the goal is and send the lawyers on their way. And first thing he says to me, well, my partner's like getting his camera set up, so it's just the two of us, and he goes, "What do you know about stamps?"
Mm-hmm.
And I go, "What do I know about wine?" And he goes, "Fair enough." But like I started a wine business when I was 18. I didn't know anything about the business or whatever. But like when you're starting it as a full-time thing and that's your entire devotion in life and you're young and you have time to learn, that's a little bit different than like, let's spend $1 billion or more acquiring a business that we don't know anything about.
Yes.
Like we don't know anything about that industry. Because like I'm scrolling down the Wikipedia here and it's like, we're jumping from pipelines to hotels to chip manufacturers to like name a thing. It's like it's a pretty diverse group of companies. Because like everyone that I was talking about, like when I was starting to tell people, oh, I'm buying another business, they would go, oh, you're buying like a brewery, like you're buying another liquor company, like you're buying something adjacent to your to your company at all. And I go, no, I'm not. But at least in my case, it's like, I know manufacturing, I know B2B sales, I know supply chain management. Like a lot of the skills that I've learned doing my winery extend to the stamp company. It's not like it's a completely different thing.
Yes.
But so I guess like my question would be like, is there worry going into new industries? And also like at the end of the day, is operating a business just operating a business? Like if you are a good operator, can you operate any business?
So I always worry. I'm always, again, it's my largest holding. It's 14% of my portfolio, which I don't know about you. For me, that's a lot.
Mhm.
And if you take all the Brookfields, because I also own the asset manager and the renewable, it's 20%. So I
Which
am all
20% is about what I'm on Northwest Company. So
wow. So you should
yeah.
worry too. Although I mean, Northwest is yeah, I think it's pretty predictable. But no, so one of the things that I like at least that make me feel better is Brookfield. They kind of learned their lesson in the 90s again when stuff didn't work out, because it's not just about what industry you're in. It's also about the type of cash flows that you get. Are they recurring? Are they predictable? Or are they just all over the place, right? So some of what they were investing before, like the mining industry, mining, you have 10 years of making amazing money and 10 years of making amazing losses,
Yeah.
right? That they hate that. So they got out of that kind of stuff, but they kept the businesses that actually had a much better cash flow profile. Like hydropower is great because it's just working all the time and your money's pretty constant,
Yeah.
and so on, right? So obviously, as they started growing again, they started diversifying again. But at least as you do that, right, it's almost like you have separate companies that are like in their own little silos with professionals on that specific industry, right? So they have, let's say, a senior analyst that has only ever done real estate in their life, and they'll the farthest they'll go, is from like a commercial like retail property to a hotel property. But they're not gonna all of a sudden go to chip manufacturing at Brookfield Infrastructure, right? They'll stay in the retail group. And you have the same with the other groups. So they're organized in, again, the infrastructure group, the renewable group. Obviously they have property, real estate groups. The one though where I have the most worry, I spend a lot of time thinking about it, and actually, ironically, it's their least successful venture. It's the Brookfield Business Partners, and that one, to me, it's like their laboratory of just trying stuff. Currently, they are in talks, and there's been articles kind of trickling about it every couple of weeks. They're in talks to buy a Spanish pharmaceuticals business called Grifols that does a lot of stuff to do with blood and plasma services. To my knowledge, I don't know that Brookfield has any experience in that kind of stuff. Now, to be fair, they want to acquire this in partnership with the founding family that owns a big chunk of it already, right? So it's not like Brookfield would just tell them to go away and that they're going to run the show. Will be in partnership. But still, I don't think they have very much experience in that kind of stuff. So that's where the worry is. But again, if you think of the fact that they are diversified, and that again, this is like one small chunk, that is the chunk that I myself have never invested in, the Brookfield Business Partner subsidiary, whereas I had invested in the infrastructure, in the renewable, in the corporation, and the asset manager. And at least in the meantime, the asset manager still does make money from everything that they do in the business partner subsidiary. Does that make sense?
Yeah. What's the mission statement on this Brookfield Business Partners? Like, what are they? Because, okay, I got a list here. They're investing in a automotive battery manufacturer, a bath manufacturer, bathroom fixtures,
Mm-hmm.
a casino, it looks like, in Las Vegas, the lottery division for a scientific games in
In the
Las Vegas,
UK.
Nevada. Not sure what that means.
Yep.
Las Vegas, it says, so I
Yep.
don't know. Gas stations.
Brookfield Business
Uh,
Partners is all kinds of stuff.
yeah, this
It's a diversified
I
mishmash.
see
Basically,
no.
no. Basically, what Business Partners is, it's where it's stuff that doesn't fit anywhere else.
Okay,
Basically, as
yeah,
far as I'm concerned, right?
yeah.
It's a diversified mishmash of a bunch of stuff. That's actually where they bought Westinghouse first, the nuclear business I told you
Okay,
about earlier, right?
yeah.
Because at the time they didn't know if that would be a fit for the renewable thing, right?
Hmm.
And then eventually they sold it on to the renewable.
Yeah, I'm scrolling through these holdings. It's ridiculous. Some of the it's like 70% of a private water and sewage company in Brazil. Like,
Yeah.
wait, they bought Westinghouse from Toshiba,
Oh, is that who they had it from before?
apparently.
Okay. Yep.
Yeah, Toshiba completed its sale of Westinghouse Electric Company to Brookfield Asset Management in 2018.
Well, there you go.
I love following who owns what, and then you just always get back to like Hitachi
Yes.
or like somebody that makes a television.
Yes.
Like I always find that funny. Um,
Very true.
yeah, yeah, because like I guess that worries that sometimes worries me when it's like you're too diverse. It's like, how do you really care about all these weird subsidiaries, especially when you're owning like 30% of one? It's like, I find it hard. I guess like I'm trying to put myself in the shoes of, obviously with someone who owns two companies, it's like I'm very involved and make a lot of the decisions in both of them. But it's like,
Yes.
how can I have any motivation in the morning to wake up and care about a company that I own 20% of through a subsidiary? Like, I own 20% of a holding company that owns a subsidiary that owns 30% of a subsidiary that owns 30% of a company in a
Yes.
country I've never been to. It's hard to wake me up and motivate me to go, let's increase those sales.
Oh yeah, no, 100%. But again, and this is why it's important to keep things in perspective. In that, someone like a Bruce Flatt, he doesn't wake up and think, "How am I going to increase the sales of this water sewage company?" or something like that, right? It's really the top of the sovereign wealth fund where it's like they get this 5 billion annually of free cash flow now. Where is it best to be allocated? Is it, do we buy back our own stock? Is it we buy another company? Is it do we invest it in one of our funds that Brookfield Asset Management manages? Which one, right? That's the kind of questions that they wake up thinking every day. And then they think to the future, what are some of the large trends that will be happening later where maybe we can build another fund around that and get more money from someone else and buy more businesses, right?
So structure wise, like let's say like Brookfield Business Partners just happens to invest in a unicorn and they make, billions of dollars in profit one year for some, some hype, some fad or whatever.
Yep.
Um, so that that profit trickles up to the holding company.
It completely depends on the agreement. Sometimes, so Brookfield has the right to exclude to a certain percentage some of the subsidiaries. So basically, Brookfield Corp, they have the power to do whatever they want, right? So if they see an opportunity and they say they want to buy it, but they don't want the subsidiary to, for whatever reason, to my knowledge, they haven't done that. But if they want to, they can do that, right? Usually, though, the vehicle for investing is via the subsidiary. And at that point, Brookfield Corporation, they get their profit from what do you call it, the like the dividends that the corporate, like the
Yeah.
subsidiary pays back, but they also get a piece of the carried interest is the profit that happens when the asset manager closes a fund. So if, let's say, Brookfield Business Partners buys something, and then 5 years later, the asset manager decides that it's time to sell it. The corporation would take a chunk of that, and throughout the whole duration that the business partners also owns it, the corporation would get dividends from that. So it's like a two-pronged type of profit.
Okay. So I guess I'm wondering like if who's making the decision to make an acquisition? Like, is it the parent company that makes a decision and then assigns it to a subsidiary, or the subsidiary is kind of operating independently and making their own acquisitions?
The asset manager does most of that. The
Okay.
subsidiaries at this point, they're not even really doing that much. You should look at it as an arm of it's like a leg of the corporation, right? So the corporation is right here, and my leg is there, but it's attached to me, but my head is the one who makes the decisions. Do you know what I mean? So
Yeah.
actually, the subsidiaries are almost, and also, by the way, this is one of the parts where some people, and this rightfully, it's a criticism where it's like, oh wow, it's not super clear the first time you look at their website, let's say, but those subsidiaries are almost like funds basically. So it's not like a bunch of people that are like doing stuff. It's more just an existing structure where you can buy it and you own a piece of the corporation, but that is basically just attached to the the assets that you like basically, right? But
Yeah.
in terms of the people that are making acquisitions and like changing the businesses and doing all that stuff, it's Brookfield Asset Management,
Okay. Yeah, because
right?
I see what you mean. Like if I didn't want to invest in the REIT, but I wanted to invest in the renewables, that's an easier way to do it. But I
Yes.
would I like without diving into it because I have a very cursory knowledge of all this, but I would almost want it all these subsidiaries to be private, and then you have one fund that you can invest in, and then they deploy your money as effectively. Because like at the end of the day, we all like to think the stock market is full of rational investors who are allocating capital, based on logic and whatnot. But at the end of the day, maybe Wall Street Bets thinks they can short squeeze
Right.
Brookfield business partners in the stock. Like, you know what I mean? Like,
Yes.
I feel like it's one more added layer of not only complexity, but like unnecessary, not risk per se, but like just a uncontrollable variable
Yes.
when like what you're
100%.
trying to accomplish
Yes.
is not in line, I think, with the, like so many different stock prices and whatnot.
Again, optionality.
Yeah.
That's it's always, they always have to balance that versus what you're mentioning, right? The risk of having so many things going on, right? At this point in time, they prefer having it like that. But like I said, if they saw an opportunity that made sense, they would reprivatize the same way they did Brookfield Property Partners, right? Which
Yeah,
used to
which I,
be
yeah,
one of the
and
tickers, and now it's fully owned by Brookfield Corp.
yeah, yeah, and I guess that was relatively recently, and
That was
there's
during
precedent.
pandemic.
Yeah,
Yeah.
so there is precedent for them to do that.
Yes.
Um, how? Because I guess like did they open all of these subsidiaries basically at the same time?
No, no, no. It's
Okay,
been spun off over time. I
okay,
think the renewable was like what, 2008 maybe? The infrastructure was like 2010 or 2011, something like that.
okay.
The reinsurance was the most recent. That was like a couple years ago. And then of course the asset manager like just
Yeah, yeah.
a year ago.
Okay, okay.
And
Yeah,
if
because
again,
I
if they get into like tech or something,
then they might.
you'll get a Brookfield Technology Partners that will be spun off as well. I can see something like that coming. Although they did publicly say they're looking at financial infrastructure as kind of the next, frontier of areas that they're looking at.
Mhm.
They bought some of those like payments provide kind of like a PayPal of the Middle East. That's why I mentioned Dubai, that they're doing stuff over there. Like when I was there, I was at the Starbucks, and you have those little machines where you tap the credit card, right? And it was a Magnati machine. Magnati's the company. So they've been buying up this kind of stuff. They hired this guy, his name is Ron Khalifa. He's like one of the most acclaimed banking professionals in the UK, actually, for this kind of stuff, financial tech, and now he's the head of like their new division that's looking at that kind of stuff. So you can expect more of that to come too. Now, as far as I know right now, this fits under their Brookfield Business Partners umbrella too. But if, let's say, it were to become a giant thing, maybe it would be its own thing too.
Yeah, because definitely think that's the smart way to do it is like slowly and surely and
Yes.
don't rely on because there's a lot of big companies that don't like to admit it, but rely on their stock price more than they rely on, selling a good product or whatnot,
Oh
right?
yeah.
Like where, I won't get too specific, but I've talked to, reps in the liquor industry that like my province specifically in Manitoba is we're very high taxes for alcohol. It's an outlier for
Mm.
the rest of the country and the continent. And we have very restrictive liquor laws, outdated liquor laws, and it's very hard to operate here. And I know some reps for multinationals that they lose money in this province,
Mhm.
but um, you're not going to have a province where you can't get Smirnoff vodka, that you can't get Crown Royal. You're not
Yes.
gonna be like, oh, we're just not in this region, right?
Right.
So they call it like a loss region where you're allowed a certain amount of those. And but what happens is you get to say on your quarterly, we're in this many regions and we do this many gross sales. And even though you're losing money and it's bringing it down a little bit, stock goes up because you're in more regions. And tangentially like very hard to compete with that when you're a small company that needs to make a profit to live. Very very difficult to compete with that when they're like, oh yeah, we can lose money, it doesn't matter.
Yes.
um so there's um yeah, I don't know. It's interesting that like there's companies that focus on, well, we just want our stock price to go up, rather than companies where it doesn't seem like Brookfield with all their subsidiaries. Because if they cared about their stock price going up, they wouldn't have 5 public subsidiaries that all
Oh
the
yeah.
money makes all the prices go up and down and
Yes.
whatnot. They would focus everything, right?
You touch on a
Um,
good point here, is that, I mean, to be fair, every publicly traded company, even if they say they don't care, they do care, right? At
well, of
least to
course,
some
yeah,
extent.
of course, yeah.
But yes, Brookfield, within, let's say, the landscape of the private equity type of space, right? They are certainly, and this is what I said when I meant earlier, they were low key. They are less focused on that kind of stuff and more focused on actually, building a business that makes profits. Because and again, this is part of their DNA as owner operators, right? Because they spent the vast majority of their history not having a stock price. They were just owners of businesses and they just wanted to have a business that, makes more profit than losses and just operate it, right? So they still work with that kind of mindset. And another thing that they do, which I find very cool, is they tell you, and you can read this in the Bruce Flatt's letters to shareholders. They tell you what they think is the value of the business versus the price, and they always tell you, listen, like the price is all over the place, but focus on the value because that's what we would tell you if there was no stock price. That's what we would say we think the business should be worth or whatever, right? So it's nice to get that kind of like owner feeling, and they just tell you take advantage of the stock price when it's low and buy, and
And
when it's
yeah,
high, opportunistically sell or do nothing or whatever. But focus on the value of the actual business.
when I guess if
That
like
differentiates
a
them.
yeah, and I guess like a big if the company a big thing that they do is buy back their own stock, at
Oh
times,
yeah,
it's like then that if you believe in the company, then that gets you more resources to use in the future, right?
100%.
Yeah,
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 and they've been like they were kind of shy with buybacks last year. Wasn't too satisfied with that, but this year they've really been like I think they bought like what $1 billion worth over the last like trailing 12 months, which is not bad. It's good.
okay,
So they're keeping that up, and it was like 200 million last quarter, so it's good.
yeah, okay. So I guess I'm relatively convinced about their modern day operations. They seem like obviously you're biased, but you are
Yes,
very, very passionate about this company, and most of what I know about it, honestly, is from your tweets and stuff. I like your 40 tweet threads about different things that
yes,
they're doing and whatnot because it's a company I've never heard of, and I'm like, oh, that's like some of those things. It's like, oh, this is like really cool and it makes a lot of money and it's something you would have never thought of
yes.
existing or buying, which you know, that's what I like. I think I get a lot of people that say that about this like stamp company acquisition as well, is that like
Mhm.
it's an industry that no one ever thought of, never thinks about. It's not very flashy, it's not very consumer based, but it's like making money. And I think there's a lot of that in
A lot of
Brookfield's
parallels.
portfolio that are like,
Absolutely.
no one ever thinks about, but that's not what we're doing. We're not trying to make people think about it. We're trying to make people, we're trying to make money.
Yes. No,
Um,
I certainly am biased, but I would say, of the people who are biased, I think it's mostly in good faith. Like
mhm.
I'm always stress testing my portfolio. You know what I mean? Like I'm not afraid of saying like, man, I got this wrong and sell out of something, right? I did that with Scotiabank not too long ago, and I've held Scotiabank longer than I had held Brookfield before. And for years I said, I think Scotiabank's gonna be all right. It's gonna be all right. But then at some point, I like again, I'm data driven too, right? Scotiabank
Yeah.
has not been all right, and I'm almost changing my mind on TD right now as we speak. So for Brookfield, I have been stress testing my portfolio. And then when last year a lot of people said, "Oh, it's real estate is gonna entirely collapse," I just was looking at the headlines, but I was also looking at the business, and it's like, yeah, some of their real estate's not doing well, but if you have like say, let's say $100 billion worth of real estate, if just 5% of it does poorly and collapses, that's $5 billion, which is more than the market cap of a lot of Canadian companies. Do you know what I mean? So
Yeah.
it's about balancing kind of what Brookfield says, what the news says, and then what the facts say. And sometimes not all of those things are the same. So you have to kind of decipher, obviously.
Yeah,
But
I think the
based
truth
on my
lies in
research,
the middle usually.
exactly, yeah. But based on my research, I do think broadly this is a company in a pretty solid financial position. They're really entrenched in all kinds of places. They have a very enviable position within that industry in that they are a partner of choice again for a lot of those big institutions. Because remember, all those funds and all that, they have tons of money that they collect from everyone, and they need places to put it. And at this stage in the world, there's actually not a lot of global players that are able to take that money and do anything with it that's productive, right? There's a reason that Microsoft, oh, we should have spoken about this. Microsoft selected Brookfield as for their power purchase agreement, right? Which is it's the largest power purchase agreement in the entire world. It's 8 times larger than the last, like the second biggest one. And they picked Brookfield to give them clean electricity now. It's like 10 gigawatts worth. 10 gigawatts is a lot, by the way.
Yeah.
Right? So they've really built this niche for themselves. And it's hard for me to imagine them kind of like not succeeding, let's say in the short term at least, right? So I'm always assessing, obviously, are things going to change, yes or no type of thing. But for now, I'm quite optimistic about it, and of course that's why I still own it.
So I'm more. I kind of let's move into this next or last chapter here. I want to focus on this kind of 1959 to 1992 kind of era
Hmm.
where I got the timeline sitting in front of me here.
Okay.
But so it looks like from founding until like 1959 when the Bronfman brothers got involved here. Um, they were mostly acquiring companies that were very like electric power companies, basically. Like it looks like they're
Yes, that's where
acquiring.
their hydro heritage comes from.
Yeah, they bought their first hydroelectric company in 1912. It looks like.
Oh, there you go.
They were doing lighting and whatnot. I don't know what lighting companies in 1904 in Rio de Janeiro did. So I don't know how. I don't know, but hold on.
It's all
When
about
was the
installing
light
this first
bulb?
electric infrastructure, right?
When was the light bulb common? Yeah, 1890s. And then that's got to be in Brazil probably way later, right?
Yes.
Yeah, so it looks like for a while there they were focused on companies that kind of were like additions to what they're already doing, right? Where like hydroelectric companies benefit from scale in a big way.
Yes.
My province gets 115% of its power from hydroelectric power. Um, we sell a lot of it to the United States.
Mhm.
Have a lot of rivers and whatnot here, especially these like up north. We got these big, massive dams and publicly owned utilities and whatnot. And anyway,
I didn't know you guys were so big on hydro. That's pretty cool.
yeah. Manitoba Hydro is the name of our power company. They're like people that move here. They're like, oh yeah, I got to pay my water bill at Manitoba Hydro. It's like, no, that's not the water company. That's the power company
Oh,
actually. Um, yeah, no, we have these dams over the last. We had a NDP left leaning
yep.
government for 20 years, and they just put 50% of our GDP into building hydroelectric dams,
Wow.
basically.
Hmm.
And yeah, we have these massive projects up north that we're generating a ton of hydroelectric power. That's basically all about the power creation that we generate right now. Um, which is great until it's not great because then we had a drought a couple years ago and we had
Oh.
to turn on the coal plant, so that wasn't
Oh.
yeah, that wasn't great.
That's
But
pretty bad, but yeah.
yeah, for the
But
most part, we are very hydroelectric focused, which is funny that I'm learning for the first time that Bruce Flatt is a University of Manitoba alum and
yeah, man.
born
He's a
with
Winnipegger.
yeah, born within 9 kilometers of where I was born. So um, it makes me wonder if Brookfield's holdings in hydroelectric power, you know what I mean? It like comes back to
Yep.
his heart sometime. Anyway, but so up until the 1950s, 1960s, it looks like they were basically in the same kind of business, and then they just start buying real estate, timber companies, mining
All kinds of
companies,
stuff.
all
Yep.
kinds of stuff. Do you know much about what their kind of ethos was, what they're kind of like, why were they buying these companies? Like,
Bronfman,
yeah,
ambition.
yeah, they were
They
just like, oh, we
just
can make money here,
they
let's
just
buy it.
wanted to build an empire.
Yeah, and you were saying they were buying
Everything.
everything, and you were saying they were buying like 51% of stuff,
Well, 51, 52, whatever. Like they were buying majority control of
but not.
companies.
I mean, like the
Yep.
distinction though, not 100%.
Yes, that's correct.
Okay,
I mean, I'm sure they also like they bought like literally hundreds of companies. Like
okay,
it was a very large operation. So I'm sure some of them they bought fully. But what basically the thing that Jack Cockwell, it was really him who started that thing of buying not everything, but like a controlling stake in something. The goal there was to get a lot done with not a lot of money, basically. And it worked until it didn't.
Yeah, because I guess it's half the money to buy 51% than it is to
Yep.
buy 100%, obviously. But I could definitely see how that could blow up eventually because it's like on top of the leveraging, which is, that's another conversation, is like I find I'm trying to like articulate my thoughts, but it's like if you want to buy a private company and operate it, I think it makes more sense to buy 100% of it. And if you
Yes.
don't, then just buy the stock and don't
And
have anything to do with it.
that, and
Right.
also you have to be ready to own it forever. Like it
Yeah.
has to be a lifetime. Like obviously for Brookfield's fund, it's never a lifetime commitment, right? Because they do buy and sell stuff for their funds. But whenever they buy it with the mindset that they they can buy it and hold for their entire lifetime. And whatever happens, they will survive with the cash flow that the company that they bought generated and not to be rescued all the time. Now, obviously, on some occasions, they did get bailouts from the bigger Brookfield because at the end of the day, it's an ecosystem and it's a competitive advantage. But it's never the goal to buy something and then have to rely on, Brookfield Corp then sending them cash infusions, right? They did that with Canary Wharf, like what, a year ago. It was them and the Qatar sovereign fund because they're co-investors in it. They actually added some money into it because they believe in it long term. But that kind of stuff, usually they try not to do.
Because, yeah, that's at least now, it might change, but that's kind of where I want to be with my businesses is that I don't know how I feel about children, but, I kind of like the idea of having sixth generation CEO of my investment company, you know what I mean, where I can like
Mhm.
pass assets down rather than when I retire. And no shade to the people I just bought the business with, but it's like having businesses that run themselves in quotations, like have operators and CEOs and whatnot that can run them,
Yes.
and keep building that exponentially for forever, right? And just
Yep.
pass it down and pass down my controlling shares of the company to my children and so on and so on and so on. Would be like kind of like my long term kind of idea of where I want to go, but also I'm 28 years old and my priorities might change and whatnot. But I don't really like the idea of buying and flipping companies. I would rather buy a company, increase the value of the company, and then collect the dividends. Because
Yes.
the work you do, I feel like from experience that it's like you put in a lot of work at the front and then you get kind of fruits of that labor, indefinitely or and that's kind of my investment ethos as well, is that that's why I prefer um, dividend investing when I'm buying public companies than because a lot of people, and this is the debate as old as time, is whether dividend investing or long term investing or whatever. But it's like I tweeted, I every so often I try to tweet something controversial just to get engagement, but it's always like a lot of truth is said in jest kind of thing where like I
Yes.
believe it, but it's like I'm not actually being that mean about it. Like yesterday I saw a bunch of people tweeting about I guess college football is starting or whatever. So I said like anyone who's watching college football is literally it's uh Jovenal, the Roman emperor, the bread and circuses thing where they're like
Oh, yeah.
we're getting so rich and everyone else is getting so poor, and the emperor responded to him, give them bread and circuses and they'll
Yep.
never revolt. And that's how I think about sports. But I don't actually care if people watch sports, but that's I just I got to
That
be a
must
little
have
bit
struck a nerve a lot of people. That
yeah,
comment.
yeah, which
Yeah.
is that's the whole point. But
Yeah.
I tweeted something along the lines of like the whole 4% withdrawal rate or whatever the nowadays, whatever the modern thing is, where you withdraw 3% a year of your stocks until you die. And then
Yep.
that's like the magic number or whatever, because the S&P 500 is growing at 10% a year on average. You withdraw 3%. So then, yeah, I tweeted something to the effect that that was selfish and a very Western um, individualism kind of thing, where like we've forced, like we used to build empires, we used to think in 1,000 years, like we built Babylon and we built Rome, and now we're just gonna take all our money out and then die with nothing.
Mhm.
and I don't really like that.
Yeah.
But I got a lot of pushback on that one.
I can imagine, especially here. Yeah.
Yeah, yeah, but I don't know. I've been meditating on that a lot in the last couple of years, where it's like we're so divided as as kind of a culture, where it's like we're all
So
just
much,
like,
man.
oh, it's just save up money and then withdraw it all 4% a year until I die, and then leave whatever for leave the house for the kids or whatever it is, right? But it's like we used to these can't be the same humans that were building empires, right?
Hmm.
And giant walls and giant castles and stuff. I don't know. I don't know. Like Alexander the Great wasn't like, how do I retire? Um like I don't know. But so that's like my kind of how I want to build a investment company, is like with the idea that it will survive past me.
Yes. That's a very noble goal, man. And again, this is why, if this is how you feel, if you buy a share or two of Brookfield, this is what you're getting. Because that's exactly it. Even with the occasional flipping, right? Because you have to remember too, this is what one last thing though I do have to add, right? Is that they are still organized within some of those themes, right? Like the renewable infrastructure, real estate, and so on, right? It's just that within those groups, there'll be times when the thesis breaks, even on their end, and then they just decide that they have to exit. The same way they did mining, even if mining at the time was part of how they viewed infrastructure, at least, right?
Yeah, so I'm just fact checking myself because I was about to say
Oh,
something, but I just wanted to make sure
oh,
I was correct.
okay.
So I don't own any Brookfield, with the exception I own 1.0116 shares of Brookfield Renewable Partners LP,
Oh,
and I am down 14%.
oh.
I have a lot of so here's another thing I kind of wanted to mention it just at the end of
Hmm.
this, is that
You have a lot of stocks.
I have a lot of stocks, and I have a lot of one or two shares of
Yeah.
stock of companies that I have no idea what they do, and this was one of them where I just saw a ticker on Twitter and bought it, because
Yeah.
when I started doing this I was very uneducated, and I was like, oh, high dividend, that or whatever,
Yeah.
where someone would make one tweet about a stock and I'm like, well, that's good enough due diligence for me. I don't know. Like,
Yeah.
and I would
Well,
buy one share.
we're all learning, right?
Yeah, yeah. And I now I don't do that anymore. I don't buy random companies. I'm really only buying 6 or 7 stocks in the last 6 or 8 months or 9 months. But what I'm considering doing is selling all my positions of the companies that I don't really know or care about, and consolidating. Um, I still
ETF?
I May yeah, well, yeah, like but I like what I like, and I invest a lot of my portfolio in like Northwest Company because I've talked at length. I
Right.
really like how they
It's a great
operate, and
business.
I think it's a great business. And I'll have to do my own research, but after this conversation, I'm hoping or wondering if Brookfield could be one of the companies that I want to invest in, because this seems like a company that's kind of similar to my goals as far as like um investing goes. And like I always clarify this when I talk about it. It's like public investing in public companies is what less than 1% of my investing. I
Right.
pour all my dollars back into my private companies. I
As you should.
choose, yeah, I choose to take I think $15,000 last year in salary, so that I can put it all back in the business. And like my winery, like we moved into a new building. We went from 10 seats to 100 seats in the new place. I got a restaurant now, big patio. We do live music and events and stuff. And that wouldn't have happened if I was drawing $50,000 a year from the company. I take
Right.
all my money back that I could be buying, Northwest Company or Brookfield shares with, and I pour it back into my companies, because at the end of the day, I believe very highly in my own skills as an operator. I can believe as much in Bruce Flatt as anybody, but at the end of the day, I believe in myself a lot more, and I know that I can
Mhm.
um, get more value for my money, I think, from investing in my own companies.
That's the way to
Um,
go, man. one
Yeah.
thing that I would say now that you said maybe you'd buy a Brookfield share, I'm putting my conservative hat on.
Okay.
Firstly, not financial advice, but also though, Brookfield is, on all of them, honestly, all the tickers, extremely volatile. Like they move 3-4% per day sometimes, which is more than the average.
Hmm.
That means, price matters, obviously, right?
Why do you think
Try to
that is?
time it right. Why? I don't know, because I mean, firstly, I guess it's very large. It's also very interest rate sensitive, right? I think they're perceived because they're very much like real estate exposure, for example,
Sure.
stuff like that. I think a lot of people kind of get a little scared sometimes. So, for example, Brookfield Renewable, I've been buying like a lot. Whenever it's like under $30, I'm talking about Brookfield Renewable Partners, not the corporation, okay? So BEP.UN, which is probably the one that you own. I've been
That
buying
is, yeah.
that whenever it dips under $30, and then, I mean, when it dips over, I haven't been selling. I haven't sold a single one of those, but I could. Like, if I wanted to play the trading kind of game, that's what I would be doing right now. Brookfield Corp, I bought a lot of it in the low 40s, again, in Canadian dollars, right? Now it's in the 60, whatever. I'm not touching it, but it's had some really violent drawdowns. So if you are considering it, perhaps wait for a drawdown. It's also not trading at the attractive valuation that it used to in 2023, right? At the time, I mean, that's when I was really screaming about it because it was
Yeah.
trading at like 10 times free cash flow,
Yeah.
which to me is extremely cheap. But
Up
now,
48% on the year.
yeah. It
It
was so
is
undervalued in my
crazy. Yeah.
opinion. But
Yeah.
now it's still attractive, but less. So I haven't bought a single Brookfield share now in a while.
What do you think about the dividend?
Of which one? The Corp?
Yeah. Like, do
It's very
you
low, which is what I want actually. It's like 11% of their distributable earnings. That's
do you
how it should be, in my opinion, because I prefer that they reinvest it.
like do you think they should be do you think no dividend would be better?
Yes,
Yeah. I almost
they're
think for
they're
the
doing it and they're increasing it, but I would rather none at this
yeah,
point.
because I like
Yeah.
I know what I just said about I prefer dividend companies, but for a model like this,
Yeah.
I almost think that it would be more like, my like Northwest company has like a 6% dividend or whatever. They're not buying a new company every few months,
Yeah.
which is
Right.
very like you got to have a lot of capital to keep doing that, right? Like, my favorite companies that are dividend payers aren't spending this amount of money
Yep.
all the time.
No,
So
totally.
I almost think for like a business like this, it would make more sense. Just like how I'm paying myself, I choose to pay myself less of a dividend
Yes.
to expand my own businesses. I almost think that would make more sense.
Completely agree. I that's one of my kind of not frustrate. I mean, it's not a big deal because again, the dividend is tiny to be
Yeah,
honest, right? It's like
0.6%.
10%. No, it's like 10% of their free cash flow, so it's kind of nothing. But
Yeah.
it would be like I would rather see that be it going all into buybacks right now, for example, right? Even at current price, I think it would probably be better, but they are committed to paying a growing dividend, even if it's very small.
I guess it makes like the investment more attractive to people.
Yes.
And I guess it kind of shows strength as a company in a way where it's like if you can announce that you've raised your dividend,
Yeah.
it's almost like
It's
whether
part
it's
of that.
true or not.
Right.
Um, then we see like Realty Income Company
Yeah.
commit to raising their dividend every month, and then you kind of look at that chart for the last 5 years, guys, and tell me what what you think about that. But
I will say another thing about their split that they did, right, with the asset manager was to give that optionality again to the dividend people. If they want a dividend, like a Brookfield stock that pays dividends, they could buy the asset manager, which pays virtually all of its cash that it generates into dividends. And they can do that because they have no debt, and it's asset light. They have no assets either, right? So Brookfield Asset Management now is able to do that. Whereas Brookfield Corp is the one that pays the low dividend, which is actually now lower than when it was combined with the asset manager.
yeah, an asset manager 3.38% yield right now on current
Yes,
prices.
something like that. Yeah,
Yeah.
and they're paying all of their cash flow in dividend.
But I guess that's their model, right? Like that's
Yeah.
what a kind of company like that does would do, right?
Yes.
And then which one's the private one? The infrastructure or the properties?
Oh, yes. There's no
Okay.
dividend there. It's all
Yeah,
within the corp. Yeah, correct.
yeah, yeah. Well,
Yeah.
that's like that doesn't like that's didn't you say one was private?
Yeah,
They
yeah.
took
It's
it private?
privatized. Exactly.
Is it?
Yeah. So it's within the corp.
Okay. It still has a TSX ticker question mark?
That might be one of their funds. They also have some other little funds that are like not like they have I think something called the Global Infrastructure Fund or stuff like that. But those are not their official subsidiaries. They're just some one-time funds that they created, some of which trade. You can find many tickers of Brookfield stuff, but I don't know which one is the property one you're referring to right now.
Brookfield Property Partners LP.
Let's see.
I got TSX BPYP.
Oh, that's the preferred shares,
Okay.
like preferred stock.
Headquartered in Hamilton, Bermuda.
Yep.
Population of 800 people
Yeah, all their subsidiaries are in Bermuda for
for,
tax.
for tax reasons.
Yes.
I love net income 0 billion. Just round it down, guys. Um,
Yeah, man.
very
So,
interesting. Like there's definitely I have like 7 tabs open now. There's a lot of
okay.
like
Yeah.
reading I'm going to do over the next couple weeks of because like every time I click on a link, there's like 7 more things. I'm like, really? This exists? Like,
One thing that
definitely
helps a
interesting.
lot. Yeah,
Yeah.
one thing that I think is definitely the actually, oh, they're gonna have the next one. I was gonna say their investor day. It's long
Hmm.
video. It's like 3 or 4 hours. But if you watch that, they give a pretty long explanation kind of everything that they're doing and how the whole ecosystem converges together. So their best one yet was the one they did last year. But they're gonna have the investor day again in like 2 weeks, I think. So you could also
Okay.
just wait for the next one. It's pretty good.
Okay. Yeah, because I guess like I am a investment company that's worth $1 million, and I want to become a Brookfield $1 trillion company. Um, I think there's a lot of reading I want to do and a lot of interesting like reading about these EdPAR investments and Bronfman brothers and just see how that whole process worked. Um, and then I guess learn from the mistakes, right? Like don't
Yes.
don't go out of business and
Oh
need
yeah.
need restructuring and whatnot.
Read Bruce Flatt's letters to shareholders too. And
Hmm.
something I love to do just for fun is like going back in archives and reading his old ones from like the early 2000s or whatever, right? Every quarter he writes a letter that shareholders can read and they release it at the same time as the earnings and stuff where the earnings obviously has like the financial detail, but then the letter is more kind of where his head's at, big picture, right? But
Which the
there's
Warren
some very
Buffett
good.
comparisons continue.
Yeah, no, it's very similar to the Buffett annual shareholder letters. I mean, I'm sure that they were inspired by that when they started it, but they're very, very, very good. Because what I like to do is reading, okay, in 2007, 2008, during the financial crisis, how were they thinking about this
Mhm.
whole thing, right? It's
Yeah.
a lot of very nice nuggets of info in there.
Yeah, I saw a quote from Bruce here that said something about like when COVID started happening, people were asking him for um he assessed the economic fallout was much more manageable than all previous meltdowns
Oh
because
yeah,
I guess he was in charge during a recession and a meltdown or whatever, and he said, "Ah, this is
dude, they were in New York during 9/11. They had buildings all around there
mm,
too, right?
yeah,
So that's the thing about the long-term perspective too. And they were there during the 90s, like 80s and 90s meltdown of EdPer, whatever, right?
yeah, yeah,
So because they have this long-term perspective too, they're always able to big picture the thing. And there's an article. I mean, there's many articles of Bruce talking about this, but there is one in particular where someone asked him something like that, and he was saying every single day you will hear about, a terrorist attack, a recession, an explosion, something bad happening somewhere in the world where we have some Brookfield exposure, right? You should never count on like not having something bad happening, but you should focus on how you're gonna manage it, right? And we always bounce back as humans, and then we always grow stronger. And he says we just expect to continue, right?
yeah.
But that goes back to your question, right? When you're saying what if like Brazil nationalizes everything or whatever, right? There is always a risk of stuff happening.
But I guess yeah, calculator risk, right? Like
Yes.
reward versus
Yep.
yeah. Okay. Well, I think that basically answered all my questions about Brookfield specifically. I don't know if you have any other final things you want people to know about this company. Everything from the newcomer investor content is not financial advice, but to
Yeah.
clarify, everything I say is financial advice.
Of course.
Um,
Um, Yeah, I mean, I would just say it's a never-ending learning process, but that's also what makes it fun, right? So like as much as, sometimes some people on Twitter consider me like someone who knows a lot about Brookfield, I'm still learning every day something new. And just, dive in and enjoy because it's fun and you'll just learn a lot about business, I think, just from, reading what they're doing. Another thing too is I think definitely always study the competition as well, right? Like Blackstone, I referred to them a couple times. They're definitely a formidable opponent. It's good to understand how they work as well, and there are a couple others too in the industry, right? So always kind of when you look at Brookfield, look at it in the perspective of the whole industry. And yeah, it's I think it's a great business. And as a Canadian resident, it makes me very proud because it's again probably well, it's definitely Canada's largest business in that industry, and in many ways, it's better than its American rivals. So that
Yeah,
I'm
because
always hyped about.
I mean, like, the fact that people are like Harvard Business Review and Forbes and whatnot are writing articles saying this is like,
Hmm.
Canada's Warren Buffett and stuff like that. I mean, that's high praise, right?
Well,
Like,
not only that, but again, this Microsoft deal, like I said, Microsoft, the biggest big tech ever, right? They picked Brookfield out of any company they could have in the entire world to secure this 10 gigawatts of clean electricity because they believe Brookfield was the one most capable to deliver that at scale in the timeline that they wanted. That's really saying something, right?
yeah, it's interesting because you always hear about Blackstone being, now you got me thinking about this, but you always got me thinking about Blackstone as being like this, like, oh, they're buying all the houses and
Yeah.
like they're always
They got into the
very,
evil stuff.
yeah,
Yes.
they're very vilified
Yes,
that
they
way.
are.
Very similar assets under management though, within 100 I mean, $100 billion is nothing to be like, oh, it's a rounding error, but within 10% of each other as far
Yep.
as assets under management. And I guess like they're, because I was under the impression they were more of a they did more real estate, like they were more real estate
No,
heavy.
no. Blackstone is diversified also.
Yeah, okay.
The way that Brookfield, at least they say that they differentiate themselves. How true that is, I don't know, but in their eyes at least, is that they are positioning themselves more for again the mega trends of the future. Specifically,
Mm.
they're leaning really hard into the transition stuff,
Yeah.
right? And I think they're doing a good job of that. Whereas Blackstone is even more. I was talking about Brookfield being opportunistic. Blackstone is even more. They will just go where they can make money. And I'm not saying that in a judging way. I'm just saying that's kind of the business model, and it's been very very successful for them. But that's also why they have been vilified. I think is that they got involved, like you said, in a lot of the housing stuff, right? That like you know, people can have judgments about that, right? And they're just leaning hard into that as well. So yeah,
Yeah,
it makes them a
like
little different.
we can have our own separate political conversation, but buying single family homes as an investment as a mega corp,
Yeah,
you
and
know, I
then
don't
raising the prices, not a good look. Yeah,
I don't think you're ever gonna get people that are like, well, you get people defending landlords, especially on like FinTwit, but I think even like, independent landlords are kind of like looking at that model and being like, well,
this sucks.
you
Yes.
you can just have 50% of your Vancouver homes sitting vacant because it
Yeah.
drives the price up. Great. Good job, guys. Like while we're in the middle of a housing crisis and our prime minister got on TV today and said, "Oh, we got to start restricting immigrants because we just can't like
Right.
support this anymore." Like, it's not a great look. And I think that like at the end of the day, you can talk about um morality and whatnot, but at the end of the day, if we're talking about money, we're talking about money. But I think like without talking about it in any karmic sense, I think there is like the chickens will come home to roost eventually, and you can only fuck over so many people as a company and not have it come back eventually. So I always think
Yeah,
like
that may
treating
be
your
possible.
I don't know. I always think like treating your business partners good and treating your customers good, you know, like if yeah, I don't know. If there's
Yeah.
ever a riot and
I
people are going to the headquarters to burn it down, they're going to Blackstone and not Brookfield, right?
well, yeah, not to be devil's advocate of Blackstone because I don't want to be because I also don't like what they're doing, right? But
Yeah.
but in terms of the karma, I'm not so sure about that. Just because again, the thing is, those people in those houses are not their clients, right? Their clients is like the Qatar Sovereign Wealth
Yeah.
Fund and all those giant institutions. And not to say that they don't care. Obviously, they do care about a lot of things, but it's probably not at the top of their mind. One thing though that this whole discussion made me think of that is, we should probably mention within the climate and the transition stuff, right?
Hmm.
Another kind of challenge for Brookfield now, I think, is going to be everything to do with greenwashing accusations because there so I don't know how much you're into like studying like emissions and all that kind of stuff, but they have different types, right? Scope 1, scope 2, scope 3, right? So not everyone agrees on what are the emissions that you should necessarily count, right? So one of the standards, for example, is that you'll count just the emissions of like the you making the product, but you're not going to count the emissions of after you sell the product, the people who use it, what emissions do they have, right? So anyway, Brookfield has been facing some accusations of kind of focusing on the numbers that makes them look much better than they are, and also excluding some parts of themselves. Like they just bought this other company called Oaktree, which is an amazing business, by the way. And Oaktree has a massive portfolio, kind of like in the oil and gas sector, right? And so when Brookfield said, "Oh, this is our number of emissions," they kind of included everything except Oaktree. And all of a sudden, it changed things, right? So they're
Yeah.
kind of facing that kind of stuff, and they have this guy Mark Carney, who I don't know if you know who he is. I love that guy. He's very very smart. He's kind of like the face of Brookfield's transition funds and transition strategy. But he's doing great in terms of bringing the money, right? And courting like all, the sovereign wealth funds and the UN and all this type of stuff. But then in terms of the general public, that is going to be a challenge, I think. Um, and yeah, they're not yet out of the woods for that kind of stuff. And as they keep growing bigger, I think that's going to get more difficult. Yeah,
Yeah.
it's a big
Well,
no.
I think we should probably finish up here because we ran pretty
Yeah, man,
far
that was a
over
good
our
convo.
topic, but I appreciate it. That's good.
Absolutely.
But no, I appreciate you getting on with me. I appreciate all the interactions we do. I think it's none of my friends in real life care about any of this kind of stuff, so it's nice to like
Tell me about it, man. Same here.
have friends that are like I can engage with on the internet at least and talk about this kind of stuff because I think it there's I wasn't kidding for the camera. I have 7 tabs of Brookfield open here because I'm just like,
Yeah.
what do you mean they own this in the Algoma district? Like
Yes.
that's interesting. Like
Yeah.
but that's yeah. What do you off the record? What do you think's a good
Oh, wait. Let
60?
me.
Yeah,
I'll
we
stop
can.
recording then. Yeah.